Ladies and gentlemen, good day and welcome to the Q4 and FY’25 conference call of Rashi Peripherals Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Ms. Sauli Mangle from Adfactors PR's Investor Relations team for opening remarks. Thank you, and over to you, ma'am.
Thank you, Rutuja. Good evening, everyone, and a very warm welcome. Thank you for participating in the earnings call of Rashi Peripherals Ltd. for the fourth quarter and financial year ended March 31st, 2025. Before we begin, please note that this conference call may contain forward-looking statements about the company which are based on beliefs, opinions, and expectations of the company as on the date of this call. The statements are not a guarantee of future performance and may involve risks and uncertainties that are difficult to predict. On the call today, we have Mr. Kapil Pansari, Managing Director, Rajesh Goenka, Chief Executive Officer, and Mr. Himanshu Shah, Chief Financial Officer. The management will take us through the operational and financial performance for the quarter and the year gone by, following which we will open the forum for Q&A. I now request Mr. Kapil Pansari to take us through the company's performance. Thank you, and over to you, sir.
Thank you. Good evening, everyone. We welcome you all to the earnings call for the fourth quarter and full financial year ending March 31st, 2025. Hope you have had the chance to go through our financial results, earnings release, and investor presentation that are available on our website and stock exchange. I have with me today our CEO, Mr. Rajesh Goenka, and CFO, Mr. Himanshu Shah, who will discuss operational and financial performance as well as respond to your queries. The year 2024-25 showed some signs of stability, allowing global economics to better align with their potential. The evolving favorable environment fueled a significant 10.8% surge in global tech spending, primarily driven by strong investments in hardware and software. While IT services growth remains steady at 4.7%, the overall picture signaled robust digital adoption. For Rashi, FY'24 and 25 was significant growth from strategies perspective. We strategically invested in expanding our portfolio of high-end products and implemented a robust CRM system, empowering over 450 users to enhance customer engagement. Furthermore, we extended our geographical presence with the opening of our 52nd branch in Srinagar. These initiatives have collectively driven exceptional growth, significantly outpacing industry averages. Building on this momentum, our focus for FY'26 is on achieving comprehensive 360-degree growth. I now hand over to our CEO, Rajesh Goenka, who will further delve into operational update for this quarter and full financial year with you. Over to you, Mr. Rajesh.
Thank you, Kapil. I extend warm welcome to all the participants on today's call as we delve into the business highlights of the fourth quarter and especially the entire year. I am excited to announce that we continue to keep the momentum of all-round growth in the financial year 24-25. We not only achieved double-digit growth, but very importantly excelled in each of the verticals as planned. Our successful execution of significant projects for esteemed organizations like NMDC, Reliance, alongside strategic expansion into high-potential verticals like visual display, quick commerce, and surveillance underscores our proactive and forward-thinking approach. We have also made substantial enhancements to our operational infrastructure, including an advanced embedded lab in Bangalore and the establishment of a state-of-art call center in Mumbai. Our recent recognition at NVIDIA GTC 2025 as the best distributor further validates our unwavering commitment to making latest AI technologies available in India. Looking ahead to FY’25-26, our strategic focus is on achieving deeper market penetration through the cultivation of stronger channel relationship. We will continue to expand our reach by adding new partners, new customers, more locations to our distribution network. We will continue to innovate in the technology space and especially in the AI space with newer products, technologies and solutions. With this, thank you so much, and with this I pass on to our CFO, Mr. Himanshu Sir.
Thank you, Rajesh, and good evening to all the investors who have joined today's call. I'd like to take you through the financial highlights of the fourth quarter and full year 2025. On a consolidated basis for quarter 4 2025, total income stood at 29,732 million, so down by 1% YOY. EBITDA was at 960 million, up by 30% YOY. And PAT stood at 527 million, higher again by 12.1% as compared to quarter 4 FY'25. On a consolidated basis for financial year 2025, total income grew by 24.1% to 1,37,727 million. EBITDA rose to 17.5% YOY to 3,609 million. PAT surged 45.8% YOY to 2,097 million. Working capital days remained steady at 54 days in 2025, consistent with 24 levels, reflecting our continued operational efficiency. On an annualized basis, ROC was at 13.1% as of March 31st, 2025, and ROE stood at 12.6% as of March 31st, 2025. If we look at segment-wise segregation on TTM basis, out of our two segments, 61% of our revenue was contributed by PES segment and 39% is contributed by LIT. When we see it region-wise by location, 66% of the revenue was contributed by metro cities and the rest 34% was from non-metro. With this update, we now open the forum for question and answers. Thank you so much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Miloni Mehta from Monarch Capital. Please go ahead.
Hello.
Yes, Miloni.
Hello.
Please go ahead with the question.
Yeah, I'm audible.
You're sounding very low. Can you speak a bit louder?
Hello.
Yes, please go ahead with the question.
Yeah. Thank you for the opportunity. Sir, I wanted to understand a bit on the quarterly EBITDA margin, like what led to the growth and how have you improved it?
So, see, EBITDA margin is essentially flows down from GP margins, which is a factor dependent on sales mix. So, year on year, see the EBITDA margin has grown from on annualized basis it is 2.77 to 2.62, but for quarter it is 2.47 grown to 3.23. That essentially indicates the efficiencies and the sales mix, GP driven by sales mix.
Okay. And so secondly, what is the update on the replacement cycle for the laptops that we were expecting? How has the market been on that end?
Yeah, so Microsoft refresh is expected towards the end of the year. So that's where the replacement cycle will begin. And in next 10 to 12 months, we are expecting significant refresh happening, especially in the commercial or the corporate segment. While in consumer, the transition may be a little bit slow.
Okay, so probably, so from which quarter can we expect the numbers to come in for those deals?
So the expected is Q3 onwards, it should start the conversion.
Okay, and so just one last question. Overall, how has the data center deals that we were doing is been, and year on year, how do we expect that to move?
Yeah, I think that's a good question. So while data center overall continues to do good, but as far as Rashi is concerned, last financial year we had one single large, or rather the largest order of 1,500 crores, which we successfully executed. However, in the current scenario, we are not looking at such large data centers coming at one shot. So there would be small data centers coming up at multiple locations with multiple users. So therefore, we are looking at small opportunities of data centers across India rather than just being concentrated in one customer or one city.
Okay, so actually, sir, in continuation to that question, I wanted to understand that is there a slowdown in the data centers because of any impact from the DeepSeek side, or any lights that you can throw on that?
No, there is no slowdown as such. Only thing is the capacity addition of data centers are now happening in a phased manner. That's the only thing.
Okay, so there is no impact from the DeepSeek side, or is there something that we need to be concerned about?
No, in fact, AI mission by government is about to, or I think they have just released large orders to various AI data centers. I think that is going to be the catalyst for AI demand in the country.
Okay, sir, that helps. Thank you.
Thank you. The next question is from the line of Vinay Menon from Monarch Capital. Please go ahead.
Hi, sir. Thank you for the opportunity and congratulations on a good set of numbers. Do you think, sir, what led to this increase in GP margins? Like any product mix which we have changed, and can this be the trend going ahead?
So, Vinay, the trend more can be indicated by the annual numbers rather than a quarter. A quarter can be a mix of sales mix wherein, the GPs may tend to, or maybe sometimes deal specific. So, more meaningful trend can be drawn from annualized numbers which are, in the range applicable to the trade.
Okay. But anything with this quarter which, any mix change because, which helped the margin, because we have, after 6-7 quarters, we have come to this, 3% plus, and, while other competitors are still near that 2.3, 2.5, will we look at this 3% plus going ahead, or will we stick to our guidance of that 2.5-ish kind of margins?
So 2.5 standard margin is more meaningful to the sector, and this 3.23 is cannot be taken as a trend applicable.
Okay, great. And sir, from the cash flow point of view, our cash flow overall has worsened a little this year. Any reason why? Because generally second half our cash flows improve, but any reason why operating cash flows have, looked a little worse compared to last year? Anything of that sort? Because I think our Yota deal has been completely executed, so we were expecting some improvement there. Has that flown through, or will it flow through in the future?
So what has happened in last H2 since post-Diwali, the overall market from business point of view also has been slower than anticipated. and concurrently the overall collections also have slowed down. But while saying so, going forward, we see market also improving and collections also improving.
Okay. So we can expect improvement going ahead in 26-27?
Absolutely.
Yes.
In fact, if you remember our January call also, we had indicated that there is a slowdown in the collection, especially in the O&D quarter. Subsequently, JFM, there has been some improvement, but major improvement should come now onwards.
Okay. And on the go ahead, sir.
On an annualized basis, the impact on debtors is 5 days increase in the overall collection cycle.
Okay, that has 5 days has been increased. Okay. And the Yota deal is completely executed, right? Nothing left to...
Yes.
Okay.
Part of it is pending.
Part of it, how much?
Small piece is pending, yeah.
Small piece is pending, okay. And in terms of growth going ahead, so you always maintain that double-digit growth is what you're looking for. So enterprise, if we don't do these enterprise deals, which, Raju sir was saying that we are not going to look for these larger deals. So how will that change our overall growth trajectory going ahead?
So I would break our discussion in two parts. One is our regular run rate business, and the second is our large project business.
Yeah.
I think majorly it was Yota only, which was 1,500 crores. So our run rate business, in last 20 years, we have delivered high double-digit growth, and our aspiration and confidence for similar consistency in the coming year is also there. However, on the project business, this 1,500 crores, whether that will get replicated in the coming year, will it be 1,500 or will it be 1,000 or 2,000?
Yeah.
At this moment, it is difficult to predict, but all we can say at this moment that smaller deals but multiple deals are going on. They are there in our funnel, but it will all be subject to actual implementation.
Okay. That goes back. I'll get back in the few more questions. Thank you, sir.
Thank you. The next question is from the line of Samir Dasani from ICICI Prudential Asset Management. Please go ahead.
Partly my question has been answered. So core business, like run rate business, what is your guidance? You can just reiterate. And second is like how to think about working capital. It is at 54 days. Going forward, what should be the range? Because that will determine our ROC, ROE of our business. So if you can throw some light on that.
Yeah, so I think on the business front, as I already explained, our run rate business, excluding the 1,500 crores, rest, all the verticals last year we have grown, and in the coming year also we have a similar plan of growth. Working capital.
So on working capital cycle, if you, like we have been telling that 54 days is something in our kind of vastly penetrated distribution infrastructure is something demands a cycle of around 50 to 55 days investment in inventory only. Our debtors and creditors still continue to net off each other in terms of days.
And there has been a 4-day improvement in the inventory.
Inventory, we have in fact improved by 4 days in current financial year.
Okay, so the run rate business has grown only 8% this year. That can improve next year. That's what we are thinking about. Okay. Go ahead.
You are right.
Okay. And margin-wise, this year we had obviously large deals. I'm sure that larger deals come at a lower margin. So should we think margins to improve next year from here on? If we are not able,
Larger deals, actually, we ensure that ROE, ROC are not compromised. So it's not low margin, I would say. I would say it's more of, protecting the ROE, ROC, and that's what we strive to achieve that.
Okay, but margins, so ROE, ROC you could remain.
Yeah, larger deals come at lower margin, but at the same time, the ROE, ROC.
But margins can improve, right, because of that?
Yeah, of course, yes.
Okay. Thank you.
Thank you. The next question is from the line of Shankar Narayanan from iThought PMS. Please go ahead.
Good evening, sir. Thanks for the opportunity. Sir, my first question is regarding...
Sorry to interrupt you, sir. May we request you to speak a bit louder? We are unable to hear you clearly.
Ma'am, could you able to hear me now?
Yes, better.
Yes.
Please go ahead.
Yes, sir. Thanks for the opportunity, sir. Sir, my first question is regarding the Q4 revenue for this quarter. So what led to the decline of 1%? So I could see that in the past Q4 FY'24, we had a 33% growth. So I do accept that a high base effect would have played. But keeping aside, what led to this degrowth, or at least we could have seen some 5-6% growth compared to our peers, right? So what led to this growth, sir?
Thank you so much for answering on my behalf 50% of the question yourself. So one, of course, we had a disadvantage of a very large base of last Q4. Second, as I said earlier, H2 the market has been flattish. Consumer market is little bit negative, but commercial market was positive. So overall, it was flattish. And third, the payment collections also in H2 was slower. So as a result of all these three factors put together, our Q4 to Q4 is flattish. But that disadvantage now is gone. So April onwards, we are back to normal, and we are quite optimistic.
Sir, usually this Q4 is responsible for commercial quarter, right? So can you give the breakup of this quarter with regards to PES or LIT segment? Or even if you're saying the commercial quarter have performed well, but that's not reflecting the numbers. That's what I make sense.
That's why I said the payment cycles also were relatively slower, and as a result, the business did not scale up as normally we would anticipate.
Got it, sir. And my last question is with regards to the quick commerce segment. So how are you seeing the...
one more point, maybe just for a clarity. We also, since someone mentioned that our debtor days had gone up, so we also went little bit in the shell, not to further extend our credit.
Got it, sir. So my second question was on the quick commerce segment. So how that segment is playing well, sir? Because it's a comparatively high margin segment than the e-commerce. So how it's performing?
So this is a new avenue. Quick commerce, as you know, is the blue-eyed boy right now. Everyone wants to do quick commerce. We are using quick commerce for all our grocery usage. But Rashi Peripherals had the first mover advantage where we work with all these quick commerce companies, and currently we are almost doing 8 or 9 brands we are distributing through them. It seems that this is an additional business that we are getting, and the overlap with the regular channel and e-commerce is minimal. But it is still, I think, at an experimental stage, especially for IT kind of products. Grocery and all, of course, I think they will be super successful. But with this first movers advantage, we are very optimistic to have a very high growth on this quick commerce business.
Got it, sir. So my last question was on our ROE. So currently we are doing a 12.6% ROE, and our plans are to increase the ROE slowly to 15 or 16%. So let's say if we are not expecting the kind of growth in the enterprise vertical, so usually it has a high receivables and payable cycles, but overall it would increase our return metrics. So what's our plan on improving our margin profiles from, let's say, 12% currently to 15 or 16%?
So on ROE, as we have taken growth capital last year, and the growth capital, when it comes into full cycle of the growth and revenues, then the ROE will come back to the levels of the standards applicable to the industry, which is 17 to 20%. So yes, current levels of 12.6%, we expect in a year or two to jump to 15%, and beyond that, then when the full capital utilization happens, it will. So as we have taken growth capital, this dip is seen in the ROE.
Got it, sir. And I expect this working capital to remain in the same range.
So we see some improvement scope in the same by maybe 5-10%.
Got it, sir. Thank you, sir. And my last suggestion from our investment community is to add the brand-wise revenue contribution for each quarter, sir, like what you have did in Q3 FY'24. From there on, you have removed that brand-wise revenue contribution in your presentation. So I request you to kindly add that in your presentation. Thank you, sir.
Thank you. The next question is from the line of Hardik Gandhi from HPMG Shares and Securities. Please go ahead.
Hello, sir. Am I audible?
Yeah.
So thank you for the opportunity and congrats on the decent set of numbers. So just wanted to have your perspective on the consumer demand in the next upcoming year. Do you see it kicking back, given that there is a tax benefit which the given? So do you think there will be a bigger spending from consumer side along with the demand from the corporates?
So while the income tax advantage may not directly affect the IT business or ICT business, that's more of leisure and easy spending by consumer. But I think considering the overall sentiment, second, overall our economical growth, and third, education, and last but not the least is the enterprise, corporate and data center, all these accelerating. And third-party reports at this moment are indicating double-digit growth in the demand per se in the coming year. And I am just back from US from some conference, and there also I heard that globally also the PC demand has already started picking up. So that's an additional comfort that we get, that in the coming year the demand will be at least double digit higher double digit.
And for our company, are we expecting similar, at least 10 to 15% growth in the top?
So our guidance always right from inception has been that our last 20 years history is almost high double digit growth. So our aspiration continues to be the same. Even if you
but high double digit growth can be like a 50% growth is a high double digit.
Yeah. So 15 to 20% growth is our CAGR at this moment is 21%. If you see.
Correct. So that's why I wanted to say these fundamental shift.
So much.
And just the second question on the margin front. So are we providing any services, or are we planning to introduce some service which might help better our margin, like even selling cloud and getting commission from that, or just on that service front?
So currently we do not have revenue from services. Whatever warranty services we do is to support our business and our brand, and that is the reason we have a lion's share of business in those particular brands. So at this moment, currently there is no plan, is the answer.
So the minuscule element of services in our P&L is coming from our subsidiary where we have 51% stake, and cloud computing services are being done through that subsidiary, ZNet.
Understood. But I've seen other companies, they are starting initiatives where they just on a commission basis sell cloud as a service to their clients and to other organizations. So any thoughts, plans to start a similar thing? Because that would just directly add to your bottom line.
Absolutely. So your feedback suggestion is noted.
Okay, understood. Yeah. Just thank you so much. Have a good one.
Thank you. The next question is from the line of Rohan Patel from Total Capital. Please go ahead.
Yeah. Thanks for the opportunity, sir. Sir, I just want to know the characteristic of a new business vertical that starts reflecting in our financials for FY'25, which is AI-based business. So can you just share some perspective on what are the customer set, what kind of business it is, like service-oriented or product-oriented, and what kind of margins do we enjoy, and how will this business grow going forward?
So is your question specific to AI or it's a generic new business question?
No, the one you are showing in your presentation as a different vertical.
So yeah, so are you referring to the Yota server deal again?
Sir, I'm talking about the that revenue that shows 1,687.
Yeah. So that's why I'm just re-clarifying. Yeah, so I think that I have already explained twice in the call that this was one large AI data center order that we successfully have executed. But the current industry trend is not to go for such large units at one go, rather than have small units and keep on adding. But at the same time, multiple customers are building up small data centers, which they eventually will expand into 2x, 3x, 4x. So therefore, right now, as against this 1,500 crore order, we are not giving any guidance that whether it will be 1,000 crores or 1,500 or even 2,000 or if not more.
Okay, and what kind of margins did we make in this business?
Yeah, the margins obviously are lower, but then the debtors and creditors also are offsetting each other. So, but percentage margin obviously is lower.
Inventory days are also less in such kind of deals.
Okay. And sir, in last call, you just mentioned that you were entering into a different set of business of embedded solution, and you wanted that to be 5 to 10% of your revenue going forward over next 3 to 5. So can you just update us regarding the developments that are happening over there, and give a sense about the business? It would look like what is that business about? What will be our end clients be? What would be that service or products?
Okay. So our embedded business is shaping pretty well. It's a very unique. It is very unique and different business. The skill set and expertise required are also different, unlike our ICT distribution where we are doing almost such a large business. We have created a separate team for it. We have also, as a part of the value add, we have created a laboratory in Bangalore where the designs, samplings are done, testings are done, and when they are ready, the prototypes are given to the potential customers to test. Once they test, approve it, then it goes for eventually production. The second question was, who are your customers? So typically, business customers, manufacturing customers, automobile customers, they are our potential customers. Some buy directly, some buy indirectly.
Okay. And would that be a margin accretive business? I hope that would be, because it's a way value-added business than that we do currently.
Yes.
So can you just throw a light on what would be our margin profile, what kind of ROE that business would generate for us?
You are talking only of embedded business?
Only embedded business.
Yeah. So at this moment, we are more into an investing stage where we are building capacity, expertise, technical know-how, laboratory investment. But the opportunity is huge. I think more than $2 billion of semiconductors are already being bought in India. We are just at the tip of iceberg, and needless to say that more value add you do in business, the margins are higher. So obviously the margins will be higher, but at this moment, today, if you ask me, it will be difficult to spill out.
Okay. And just if you might have done this calculation, what kind of payback period you are expecting from this business?
So we are already profitable on this business. When I said investments, I meant in terms of margins and ROE and ROCs. So we are already profitable if we look individually only this as this business.
Okay. So can you just give us like what kind of revenue it has contributed in this financial year for us and what kind of margin? Because we are already profitable.
So this year, about 100 crores plus revenue we have done in this business.
Okay. And we are we have already break even and now we are profitable.
Yes. Yes.
Okay. Okay. And sir, when we see historically in your presentation, we have done ROE of say 23-20% before our capital IPO money. So why are we targeting 15% ROE? Where what has changed that now we are targeting a lower ROE?
It's not targeting lower ROE, it's building up gradually. Because when you take a growth capital of such a size and the market dynamics and all what are there to grasp the opportunities, it builds gradually. The volumes doesn't come so fast.
So once we reach to 15%, obviously we will strive for higher, but our initial target is to get back to the base ROE of 15% and then build from there onwards.
Sorry to interrupt. May I request Mr. Patel to please read?
Yeah, sure. Yeah, thanks for management for answering all the questions.
Thank you. The next question is from the line of Manoj Rajani from Rajani Family Office. Please go ahead.
Hello. Am I audible?
Yes.
Yes.
Hi, sir. Congratulations on a good set of numbers. So just wanted to ask you that, given the tight working capital cycle, which is common in the industry, so what is our plan to maintain this growth and also, just without adding any debt to the balance sheet?
So I think Himanshu has already clarified that the industry standard is this, and our aspiration also is to maintain something similar or better. There are basically three parts of it. One is the inventory, second is our debtors, and third is our creditors. So all these three corners we have to keep a tight watch on this and control while maintaining our aspirational growth of double digit. So if you see last year, inventory has gone down, but debtors have marginally increased. But net, we are still the same. So there is no deterioration even when the market the H2 was a little bit slower.
So this is the current level would be a comfortable level for us even in the future?
Absolutely.
Okay, sir. And what is the range that we are comfortable with if in case it, the situation worsens?
So it's 50 to 60 days is the overall range, but we see that, the business can go or demand the working capital cycles. Not beyond 60, again, the eyebrows get raised and it gets addressed. We have that, standard deviation range of that. Secondly, more important to see here is that as long as we are able to net off debtors and creditors in terms of days, we are in the safe zone.
Understood, sir. So just one last thing. So just wanted to know sorry if it has been answered. So what is the proportion of the revenue of our top 5 OEM partners? And is there any risk of more concentration in this?
I don't have the exact data, but I can only generically answer that Rashi Peripherals is the least riskiest in terms of product coverage, because we have a very wide variety of brands and product categories, and last but not the least, our 52 branches. So we are covered pan-India. That is one of the reasons our business has always been consistent and have a consistent growth of 15 to 20% YOY.
Understood, sir. So any approximate names that you could take? I mean, just top 2 or 3 maybe?
Yeah, the top names I can say is Asus, Lenovo, Western Digital, Intel. These are top names.
That's very much helpful, sir. Thank you so much, sir.
Thank you. The next question is from the line of Ajay Shantaram Kale, an individual investor. Please go ahead.
Yeah, hi. Thanks for the opportunity. My question is, what is the, if I see the last year full year, percentage of channel mix vis-a-vis the corporate or enterprise earning and e-commerce? I understand quick commerce is still a early day baby or newborn baby, but just want to know what's the mix and from a revenue point of view and margin point of view.
Yeah, so our channel mix is 85% and our LFR is 7% and e-commerce is 8%. And we are hovering around the same. As we always explain that ICT products are not, they are a technology sales and you need consultancy in some form or the other to make the ICT products sales. Therefore, despite all the onslaught of online, the ICT industry is still dependent on the channel community, whom we call it our partners, and that is the reason 85% business is coming from channel community.
And my next question is, thanks for that. And how about profitability? What's the profit mix?
Yeah, so I was about to say that, and to add to on what I already said, that if you work with e-commerce companies, the profitability relatively is lower. So that is again one discouragement therefore since we are present in 52 cities of India, our first preference goes to the channel business. Of course, we cannot ignore all other forms of business which are e-commerce, LFR and the new one, quick commerce.
Okay, thanks. My next question is, what's the revenue mix of PC versus non-PC business of Rashi for the full year basis?
So broadly, 55 to 45% would be PC versus non-PC business.
Okay, and within this PC business, what is the percentage of revenue mix between consumer and commercial?
That number I don't have offhand to give you. We'll need to collect the data.
Yeah, so the idea is just to understand whether the consumer business is growing or commercial business is growing. So
Yeah, I think I have explained already. At this moment, commercial business growth is far higher than consumer. So for us also, our mainly growth is from commercial segment.
Okay, thank you so much. Thanks.
Thank you. The next question is from the line of Vinay Menon from Monarch Capital. Please go ahead.
Yeah, so just a couple of things. We are at 900 crore debt. Now our cash position is also a little lower. So will we take any incremental debt going ahead for growth? That is my first question. So,
see, as far as working capital cycle, when it is maintained at 54 days or to be more specific, 6.5 cycles. So yes. Any growth comes or any deviation comes within the year, the availment of debt, and then it gets normalized along with the collection cycles which happens in the business. So debt requirement will be availed or not availed depends upon growth opportunities coming into the business and what is the combination of the contours of those businesses.
Okay. And in terms of, sir, how is April, May, you're almost done with April, May. So how are things looking up? Have we seen demand increase or improve or anything, any guidelines on, how things are looking up now?
Yeah, so I think this also I explained, our H2 was slower, but this H1 seems to be on track, and all third-party reports are indicating about 10% demand growth.
Okay. And sir, on NVIDIA's Gracewell chip, the release is expected in June, July. So are we expecting some demand from that also, since we are the largest distributor for them? So are we expecting some kind of demand from that coming to 26?
Yeah, so NVIDIA demand continues to expand in consumer, commercial, and data center, all three. And thanks for you to acknowledge that we won the Distributor of the Year award from NVIDIA.
Okay, great. And this pivot from the larger deals to, more smaller, probably 200 to 500 crore kind of deals, is it because, of the margin issue, or was it because it stretched working capital in H1? Like, what was the reason for this pivot in strategy? So just want to understand.
So what I said was more market, the way the market is going on. Right now we are not seeing such large 4,000 or 8,000 GPU data centers coming up at this moment. But at the same time, demand is not subdued. We are seeing multiple data centers coming up across other cities as well simultaneously.
Sorry to interrupt. May we request Mr. Menon to please rejoin the queue? We have participants waiting for the turn.
Okay, I just one last question. If you are okay, I can. Okay. Yeah. Sir, one thing we have that, we have a 15% ROE benchmark which we want to get back to. So any plans how we're looking towards that? Because that is what the company has been, teaching since, IPO. The 15% is what we're looking at. This year obviously was a little lower, and obviously that was attributed also to the larger deal. So without this, can we go back to that 15% margin check from the ROE fund?
Yeah, it is achievable, and 15% is the target. What we have said is for short run in next 1 to 2 years time. Long run definitely remains in the range of 17-20%.
Okay. Thank you so much.
Thank you. The next question is from the line of Shankar Narayanan from iThought PMS. Please go ahead.
Thank you, sir. I just have a follow-up question. So what's our current business on our exclusive distribution rights we do have on the certain products, right? So what's the overall revenue from that right, sir?
Currently, our exclusive distribution business is roughly about 20%.
Got it, sir. So, by the way, it has increased from 15 to 17% to 20%, sir, if I'm not wrong.
Yeah, it has marginally increased, but I must say that exclusivity and non-exclusivity does not have too much of relevance in this business, because it's more demand, supply, and the value adds that you bring to the market. Also, maybe I can take this opportunity that majority of the businesses that we are doing, even if we are not exclusive, we have the lion's share in the businesses that we are doing, and that is what is more important.
Got it, sir. And for the products that we have exclusive rights, we do sell at a premium rate, sir, because we only have the rights in the market, so we have a higher gross margin in the segment, sir.
So this industry is more of a flattish, if not fixed margin. So the scope of earning extra margin even in exclusive is very small. It is not zero, but it is not very big, unlike other industry. But the positive side also is that if the exclusive product doesn't get sold, then it's not your loss. Ultimately, it will be covered somehow. So it has its own pros and cons. Not very high, but not very low as well.
Got it, sir. And regarding our recent news on SATCOM Infotech, so what have changed in the plans or the acquisitions? What have really changed?
So the SATCOM acquisition, though we announced as a plan to acquire, however, that plan has been terminated. I think the conversation between the two companies did not proceed as per plan, and certain expectations decided to end the conversation. So that is not in our radar for next coming foreseeable time.
Sir, but we do focus on acquiring companies in the business of software reselling, because our other competitors also do the same, and they have posted a good results on software reselling business, because it has a huge opportunity in a country like India. So how are we going to capture that growth in our business, sir?
Yeah, you are absolutely right, and that is one of the reasons why we engaged with this company in the first place. Unfortunately, this transaction is not going to that, but we have not dropped our plan to acquire or penetrate in this segment. Since this is still at the nascent and the drawing board stage, and we do not have concrete information or any development to share with all of you, we are just informing that SATCOM takeover acquisition is currently not progressing positively. But our focus for entering this segment remains strong, but we want to do it more based on this learning of this transaction, the way it proceeded, the way it went back or fell apart. We are now redrawing the strategy to ensure that we do not face same issue again in the next engagement that we work with.
Got it, sir. Best of luck.
Thank you. The next question is from the line of Rohan Patel from Total Capital. Please go ahead.
Yes, thanks for the follow-up opportunity. Sir, can you just give us an insight into what are your plans to, improve our cash flow from operations, because we have consistently having negative cash flow. So to grow at 10-15%, we will need a sufficient level of internal accruals, which we are lacking right now. So it will be dependent all upon our ability to borrow or raise capital, which is not a healthy way to grow a business.
So we are trying to find out, solutions and implementing those also from the balance sheet, like off-balance sheet solutions, which can help in improving the cash flows, first of all. Second thing, optimizing the working capital cycle, whatever scope I mentioned, that will also help. On funds generated from operations, definitely there is no issues, and those things are getting contributed directly or getting flowed back directly into the businesses only. I hope I'm able to answer that.
Yes, it was. And sir, just one of the, last time when I got opportunity, I asked about your embedded business. So can you just give some clarity about what kind of products or services we are working on? Like, just to give us insight.
Yeah, so these are basically semiconductor chips, and we have tie-ups with company like, again, NVIDIA, Intel, Elmos, Micron, Western Digital. We buy their chips, and these chips are then used to make some solutions. Maybe I can give you an example without naming anything. Today, a car has more than 60 different types of chips, because nowadays all the cars are totally automated, right? Again, if I go a little bit one step further, car headlight, for example, again, they are all automated. So in a car headlight, there are at least 3 to 4 chips. So these chips are essentially provided by Rashi Peripherals, because we have tie-up with those companies. But what different we do is, these solutions, for example, headlight solutions, sampling we do at our laboratory, and then we do business development work with various manufacturers for implementation.
Okay, and just if you can provide us with now at 100 crore revenue base, we are profitable. So what kind of margin we are making right now?
It's obviously higher than the regular ICT margins.
Okay, but just a rough ballpark figure, if you can give, is it in double-digit margins right now? And if so, how will this margin trajectory will be going forward?
Yeah, it is. At this moment, I can only say it is definitely higher, but the costs are also there at the same time. Once we reach to a good scale, I think that's where we will see, and that is why we are putting so much of effort, time, and energy in building this business from scratch.
Assigning a range at this level of business is difficult and inferences cannot be drawn. But as Rajeshji said, that it is definitely a higher margin.
And based on what work you are doing, and you might be having conversation with your clients and customers, can we see this business being 5x the size in next 3 to 4 years?
So as I said earlier, currently the market size is $2 billion. $2 billion matlab 16,000 crore is the existing market, and with so much of more manufacturing happening in India, more automation happening, this market will rapidly grow. So that's the opportunity. Opportunity is very large. We are only at the tip of the iceberg. But I think we are there at the right time, at the right place.
Okay. Yeah. Thanks.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Kapil Pansari for closing comments.
Thank you, investors. Thank you, shareholders, for participating this call of FY and Q4. As in all the questions and all your queries, we have answered. One outlook that I want to leave with all of you is that we have now completed with 1 year of our operations in the listed space in the public domain, where a lot of learning, a lot of questions, and a lot of deliberations has happened about how we take this company forward in the next coming years. I think the journey has been exciting, and we can only share with more confidence that the opportunity this segment of semiconductor, of the enterprise, and our traditional businesses put together contribute in this digital India of the future will only present more and more opportunities, driving growth and better profitability for all of us put together. Thank you once again for participating in this call, and wish you have a very great weekend.
Thank you so much.
Thank you. On behalf of Rashi Peripherals Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.